Warren Buffett once made a famous bet. He said that for most ordinary investors, a simple S&P 500 index fund would beat some of the smartest hedge funds on Wall Street. And he was right. Why? Because the S&P 500 was supposed to be simple, broad diversification, low fees, and patience. You were not betting on one company, you were betting on America. But today, that idea has changed. If you own the S&P 500 through an index fund, a pension, or a retirement account, you should be petrified.
U.S. markets were down sharply across the major indexes in Friday trading after a chip stock sell-off broke the S&P's 9-week winning streak.
You bought a diversified bet on America, but today the truth is that a huge part of your money is now tied to a small group of giant tech companies. And that's not the scariest part. The scariest part is that these companies are all selling the same story. AI, artificial intelligence. Before we continue, if you want more videos that cut through the market hype and show you where the money is actually moving, subscribe, because that's exactly what this channel is built for. Alright, back to the real problem. So the question is no longer just, should you buy the S&P 500? The real question is, do you understand what you actually own? Because right now, many investors think they are diversified, but under the surface, they may be holding one big AI trade wearing an index fund costume. And this is where the danger and opportunity begin. Right now, smart money is not guessing which AI company wins. The smart money question is asking, what does every AI winner need? We'll get there. But first, you need to see why this matters. I'm 50 years old, which means I've watched this movie twice. I was around for the dot-com bubble. Then I lived through the 2008 crash, which nearly took everything I had, because nobody ever taught me how the system really works. I learned it the hard way. And the lesson that cost me the most is the lesson this whole video is about. A technology can be real, the future can be real, but the trade can still be dangerous. If you buy the correct technology at the wrong time, you could wait 15 years to make your money back. That's what happened to investors in the dot-com correction. It took some good stocks 15 years to get back to their 2001 prices. And it could be happening again. Let's get into it. For roughly 25 years, the 10 largest companies in the S&P 500 held a fairly stable share of the index, usually somewhere in the high teens to low 20%. That was concentrated, but still manageable. Today, the top 10 companies are around 41% of the index. That is a very different market, and history shows us that every time this happened in the past, the market has had a huge correction. Every single time. It's pretty obvious why. Because when the biggest companies become that important, one bad earnings report from one of them could send panic about the others. And then the dominoes fall fast. Then the call does not only hurt one stock, it moves the whole index. The whole index falls. That moves retirement accounts, and then pensions. And before you know it, the safe investment millions of people thought they understood is actually the opposite. It's not diversified, and it's not safe. And we already saw how fragile this can be. Remember when DeepSeek launched? That little-known AI lab helped to raise close to $600 billion from the dominant AI chip maker in one session. That was one of the largest one-day losses of value in market history.
Let's talk about DeepSeek, because it is mind-blowing and it is shaking this entire industry to its core. The emergence of DeepSeek now putting pressure on the U.S. tech names. Now, you can take a look right now at the AI-related stocks. So NVIDIA, ARM, AMD, Microsoft, Meta, interestingly, on that list, given its open source. We've got to talk about the open source, closed source bit of this as well.
And this is the point. When the market becomes this concentrated, one crack in the AI story does not stay inside one company. It spreads. Now, I want to be clear. This does not mean AI is fake. That is not my argument. AI is one of the most important technologies of our lifetime. But there is a big difference between saying AI is real and saying every AI stock is fairly priced. That difference is where investors usually get hurt. So let me make the problem simple. Imagine someone builds the biggest restaurant in history. Not a normal restaurant. A restaurant built to feed a whole city. A massive kitchen. Thousands of workers. Beautiful tables. Expensive equipment. An electricity bill the size of a small town. And the whole thing is built on one belief. One day, millions of customers will arrive. Then the doors open. and only a few tables are full. That is the AI economy right now. The infrastructure being built is enormous. The money going in is historic. But the money coming back from real paying customers today is still much smaller. This is the gap smart investors are watching. The gap between what AI companies are spending and what AI is actually earning today. Given the uses of AI, the revenue will catch up. But if revenue does not catch up fast enough, then valuations become much harder to justify. And here's the problem I mentioned at the start. Because so much of the index is now tied to this story, the index now has this problem. This gap is not being funded only with cash sitting around. A growing part of it is being financed. In other words, borrowed money. And this is where the story gets more fragile. Oracle, for example, has been tied to roughly $523 billion in obligations. That is around 9 times its annual revenue. And some of that borrowing is happening at interest rates roughly double what the company paid before. Now zoom out. The 5 giants behind the AI build-out issued around $121 billion in bonds. Their historical average was closer to $28 billion. That is not a small change. That is a system borrowing aggressively to keep the build-out moving. So the question isn't, will AI be important? The question is, will the revenue arrive fast enough to justify the money already being spent? Because if the customers arrive late, but the debt arrives now, the pressure builds. And then we could see a 2001 style collapse all over again. So what has to happen for AI to close the gap? It's simple. We need more users, more enterprise adoption, better models, and we need them faster. And now you have the big problem: electricity. NVIDIA's Jensen Huang has said the industry is now power limited. That is the key line.
The amount of energy that we need for computing is likely, probably 1,000 times more than we currently have. And that's an enormous amount of energy.
The bottleneck is moving from silicon to electricity. A data center can be built in 1 or 2 years, but the grid needed to feed it can take 4 to 10 years. That is a completely different timeline. And in major data center hubs like Northern Virginia, the wait just to connect a new project to the grid can stretch for years. So even if AI demand explodes, even if the models improve, even if the customers arrive, the whole system still needs power. And demand is not slowing down. The International Energy Agency projects that global data center electricity use could roughly double by 2030, and the AI-specific share is expected to grow even faster. That means that right now, AI is not a software story. It is an energy story, a grid story, a cooling story, a physical infrastructure story. And this is where the personal part becomes very real. Consumer electricity prices rose nearly 7% in a single year, more than double the rate of inflation. And in some regions, data centers are now bidding for the same power that runs your house, your lights, your kitchen, your heating, your everyday life. So this is not just about stock charts. It is about the physical limits behind the digital economy. And once you understand that, the opportunity becomes clearer. The obvious trade isn't which AI company wins, but the better question may be, what does every AI winner need? They all need power. They all need cooling. They all need transformers. They all need grid access. They all need data center infrastructure. That is the picks and shovels trade. Not the most exciting story. The necessary layer underneath the story. And this is where history matters. During the dot-com bubble, the internet was real. The technology was real. The future was real. But many investors still lost money because they bought the right idea at the wrong price. They bought the restaurant before the customers arrived. In March 2000, Cisco became one of the most valuable companies on earth. It had real products, real demand, real technology. But from that peak, the stock fell around 90%. And it took roughly 21 years. 21 years. That is the lesson. The internet did not fail. But the trade failed for a generation of investors who paid too much, too early. They waited 15 years to get their money back. And that is why this AI moment needs to be handled carefully. Not with panic, not with blind excitement, with understanding. Because the question is not, is AI real? The question is, where does the money get paid, no matter who wins? If NVIDIA wins, it needs power. If OpenAI or Anthropic wins, they need power. Power wins no matter who wins or when they win, because right now we will not have enough power for at least a decade. This video is not a recommendation to go buy anything. That will be my next video. This video is a map of where to look. Transformer manufacturers, cooling suppliers, utilities with available capacity, companies connected to the grid build-out, the boring layer that gets paid while everyone else fights over the exciting layer. And this is where Buffett's lesson comes back. Buffett's point was never chase the hottest story. His point was know what you own, never overpay for excitement, and let the real economy work for you. But if the S&P 500 is now heavily exposed to one crowded AI trade, then ordinary investors need to think more carefully, because the broad index may not be as broad as it looks, and the obvious AI trade may not be the smartest AI trade so late in the cycle. Don't chase the AI winner. Follow what every AI winner needs. I'm just an investor sitting in my lounge, speaking from experience. I learned these lessons the hard way, so hopefully your portfolio does not have to. If you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.